Welcome to the KPC Smart Money Podcast with Kevin and Karen Christ. Well, you know, it's the beginning of the year, and so we thought, let's look back to 2022 and do just a high-level market review. For those of you who are in the stock market, you kind of have an idea that things didn't go that well last year, but we're going to explain why some of those things did not go well last year. I know we have clients come in all the time, and they're a little panicked at the way their retirement shrank.
Things didn't go too well last year. That is a gross understatement.
I know it's a gross understatement. I know it is.
But, so
I'm trying to bring us in softly before you hit them with the hard, cold, depressing facts.
Is that what they call the soft landing that we're supposed to have?
It's a soft opening because you're going to sit there and give them all kinds of.
Well, actually, no. I'm going to start off. We've had enough bad news, right? There's all you hear, it seems, is bad news.
I'm not done teeing it up, so
all
give me
right,
one
tee
second.
me up.
Okay. What we really need to talk about is that how you approach investing and savings changed a lot last year because we had, the signs of recession. We had inflation coming in. We haven't seen that combo in quite a while. But then on the market side, people who were doing traditional, 60-40 or some type of equity to bond split really got hit hard. So a lot of things negatively impacted people in 2022. So not only do we want to give them kind of the hard, cold facts, but people have got to change things up. We are in an absolutely different investment environment in 2023 than we have seen in a long time.
I read a lot of articles in 2022 that the title was "The 60-40 Plan is Dead." And so
we've been saying that for quite a while, but it really proved it out last year.
Well, that's right. I think we were ahead of our time. We've been talking about that for years now.
Because everybody knew a downturn was coming, but I don't think people saw equities and bonds downturning together.
Now you're stealing my thunder.
Oh, well. All right.
Okay.
Sorry.
No, that's okay. But no, that's a good point, Karen, because in the last 100 years, we've never had a situation where bonds and stocks were both down. The indexes, the S&P 500 and the aggregate bond index is a measure of the broad-based bond index, is both down double figures. So here's the facts.
And getting hit with inflation.
Here's the facts. The S&P 500 was down 19.4%. Those of you who are not too up on the stock market, what S&P 500 is an index that measures a broad base of the top 500 stocks in America. Okay, So if you took that together, if you're in your 401k, it shows S&P 500 fund. That's what we're talking about here. You should have been down 19.4% in your 401k and your S&P 500 fund. Now, an aggregate bond fund, right? The aggregate bond index is a broad-based measure of bonds, and it was down 12.95%. Now, that being said, I saw some high-yield bonds. High-yield bonds is synonymous for junk bonds because they're bonds of companies that are not of investment grade. They usually pay higher than the investment grade bonds, which are like AAA, AA, right? Okay, so a bond that's not rated or a bond that's like double B, it might be down 20%, right? So anyway, here's another factoid. The NASDAQ index, which is generally your growth stocks, your tech stocks, a lot of times smaller companies. Now Amazon is on there. That's not a small company, but you get my point. Growth and tech stocks, Microsoft, those kind of companies. NASDAQ was down 33.1%. Now, a measure of that, there's a fund out there, an ETF called QQQ. They advertise it all the time on Fox Business News. If you were in QQQ, you were probably down more than 30% in that particular fund. Amazon. Who doesn't get Amazon delivered to their door?
You think they'd
You'd think
be
they would do good through a
right.
recession, right? Minus 51% Amazon stock. Now, Facebook. Well, everybody's on Facebook. Billions of people. They changed their name to Meta. Meta.
Yeah.
Meta. You say Meta. I say Meta.
Okay.
But formerly Facebook, right? Down 66%. So if you own $10,000 worth of Facebook stock, right, it's worth now $3,600, right? So put that all in perspective. So what do we do about that? Well, if you're young and you're in an S&P 500 fund, if you look at where the S&P was 20 years ago and where it is now, if you would have just held on and done nothing, you'd have been fine. Where you have to watch out if you're listening to this and you're in your 60s or 70s or even 80s, you're going to have to look at things a little bit differently. And we don't have a lot of time during this podcast to tell you, what we think you ought to do as far as, the getting out of the regular routine 60-40 plan, which is 60% stock and 40% bonds. There's other ways to invest your money. Now, Karen, tell us about the 60-40 plan. What happened this year, and what are some of the other bad years?
Okay.
And how they rank.
So this is going back historically, looking at the worst performances of the traditional 60-40 portfolio. And 2022 ranked the third worst.
That's surprising.
That's terrible. The third worst in the last 100 years. So
I thought it was the worst. Okay.
No. Okay. So 1931 was the worst. That was the Great Depression.
Right.
And a 60-40 plan was down 27%. Now here's the next worst. 1937, it was down almost 21%, but that was the 1937 crash. Right next in line is 2022, down a 60-40 portfolio would be down on average 17%. So right now, what happened last year was only slightly better than the Great Depression and the 1937 crash in a standard 60-40 portfolio.
Okay, I said 100 years, but to be accurate, I would have to say you'd have to go back 85 years, right, to find a year where stocks and bonds together, a 60-40 portfolio was worse.
Well, and everyone talks about, we remember what happened in 2008. 2008, a 60-40 performed better than 2022.
Oh, you know what? I could be right about the 100-year thing because, stocks, the stocks that weren't as bad as in 1937 and 1930. Might have been bonds did better and stocks did way worse. But it doesn't matter. The point is they both stunk.
Right. Exactly.
They both stunk up the place. Right. So, if somebody was heavy in cash, if they had the foresight to take some of their money out of the market and sit on the sidelines, we don't believe that you should just jump in and out of the market when you think something's going to happen. You got to stay invested. Like I mentioned before.
Well, a lot of the research shows that you just can't time that right, and you're actually hurting yourself by trying to time and jump in and out of the market.
The 10 best days in the market were right after the 10 worst days.
And you missed that if you're out.
So you can't you try to jump in and out. Those people that got out of the market in 2018 and they missed all, 2019 and 2020 and 2021 were really good years.
But I think what we're trying to get across is to show you some facts about what happened in 2022 and to say, if you are sitting in those traditional 60-40 type portfolios in your 401k or in your other investments, it's time to rethink things. It is time to come up with some different strategies.
Yeah, that's right. So if you want some ideas, you can get in touch. Go to our website, kpcfinancialsolutions.com. It's all sorts of free stuff on there. And if you want to have a conversation, just hit the consultation tab, or what we call the retirement blueprint tab. Are we out of time, dear?
We are.
Okay.
But next week, we're going to talk about some of the alternatives for cash, because a lot of people are sitting in cash right now and making just about nothing. There are better ways.
That's right. Hey, before we stop here, one quick thing. So I don't want you to leave the podcast all depressed. In the last 6 months, the market's actually up 4.16%. So there was one guy on Fox Business News that was saying that we hit bottom in October and we're back in a bull market. I'm not sure I believe all of that.
We'll see.
But that's, the last 6 months has been good. And year to date, from January 1, the market is up 4.38%. So we wanted to leave with you with a little bit of good news. All right, that's all the time we have. We'll be back next week. Thanks for listening.
You've been listening to the KPC Smart Money Podcast with Kevin and Karen Christ. To listen to more episodes, visit kpcsmartmoney.com. You can also find the KPC Smart Money Podcast on Apple Podcasts, Google Play, Spotify, and Stitcher.
KPC Financial Solutions is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through KPC Financial Solutions, LLC, a registered investment company. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. KPC Financial Solutions is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by KPC Financial Solutions. Hypothetical examples have been provided for illustrative purposes only. It does not represent a real-life scenario and should not be construed as advice designed to meet the particular needs of an individual's situation.